Well, here we go again. So, welcome, everyone. Today we are going to cover, 11th chapter from the book Trading in the Zone. And today I'm comparatively a little bit more excited because this is like the finale episode of some, a big thing or like finale of what I can say a World Cup or something for me. A similar feeling, okay, but in very less extent. You got the gist, right? Okay, so basically, this is the final chapter of this particular book, and from tomorrow onwards, we are going to start with some new book. But this is not just the last chapter of this book. From the last chapter, also, we have covered the half part in the last video. In case if you have missed it, please go through it. And today we are going to cover the remaining half part. And this is very important. This is like the gist of the whole book and the crux of the whole book. Because now, throughout the whole journey of Earth, that means throughout the book, we learned about how psychology works, how belief system works, how like what are the problems that you have to come across, what are the solution that you can seek. And today we are going to learn about the action steps to find out the solution for all the problems that can we can encounter during a trading session. All right, so yes, in case if you're joining for the first time, this is very important video, so please be ready with your notebook and pen. And yes, as always, let's begin without any further ado. So today, as you can see the title, we are going to talk about the exercise learning to trade and as like a casino. Okay, meanwhile, please go through it, please read it, and I'm turning on my PPT, like I'm opening up my PPT. Sorry for the wrong choice of words, right? So yeah, it's like running notes that I make in background. So I'm just working on it, and there are already 7 slides or something. Okay, from 8th onwards we'll start. All right. Okay. Sorry for the inconvenience caused, and we are right back into it. Okay, so the topic is exercise learning to trade an edge like a casino. Okay, the object of this exercise is to convince yourself that trading is just a simple game of probabilities, numbers, not much different from pulling the handle of a slot machine. At the micro level, the outcomes to individual edges are independent occurrence and random in relationship to one another. At the macro level, that means at a smaller level and at a bigger level. Okay, at the macro level, the outcomes over a series of trades will produce consistent results. Okay, so that's what we need. All right. At the micro level, the outcome to individual edges are independent occurrence and random in relationship to one another. But at macro level, we are getting the consistent result out of it, and that's our aim, right? Consistent result means we are getting the money out of it, not just once or twice, but every single time that we are trading. Okay, so that's the very idea what we are trying to say over here. All right. Now, moving ahead, next thing, that's the general base or premise that we have got. Now, from a probability perspective, this means that instead of being the person playing the slot machine as a trader, you can be the casino if you have an edge that generally puts the odds of success in your favor. That means the strategy that is, you know, whatever is suitable for you, you need to have a strategy with you which generally gives you an edge, or it will tell you where to enter and where to exit. Okay, like a strategic plan or something. We already learned about edge, so in case if you have any doubt in what exactly edge means, what is a strategy and how exactly it works, what are its psychological implications, and how can we implement it, and all the sort of stuff around it, you can type it in the comment section and I can make a separate video around it. Okay, you have an edge that generally puts the odds of success in your favor. You can think about trading in the appropriate manner, the five fundamental truths, and you can do everything you need to do over a series of trades. Then, like the casino, you will own the game and be a consistent winner. It's not like, again, I'm repeating it and I have repeated it multiple times, that it is not like this whole book and everything that we are learning over here, it is not about winning once or twice. It is about winning consistently, getting the consistent profit out of it. Okay, getting profit once or twice can happen with anyone who has zero knowledge of stock market, but getting a consistent result out of it in a span of time, that is the thing that we are working on. Okay, from a probability perspective, okay, we already learned about these things. Let's move ahead. Setting up the exercise. So now moving to the exercise part. Pick a market. Choose one actively traded stock or futures contract to trade. It doesn't matter what it is as long as it's liquid and you can afford the margin requirements for trading at least 300 shares or futures contracts per trade. Okay. All right. So as per that, you can basically the gist is you need to have a market where you will trade. Okay. This is the very first basic step. Now, choose a set of market variables that define an edge. Okay, this can be any trading system you want. The trading system or methodology you choose can be mathematical, mechanical, or visual based on patterns in price charts. It doesn't matter whether you personally design the system or purchase it from someone else, nor do you need to take a long time or be too picky trying to find or develop the best or right system. This exercise is not about system development and it is not a test of your analytical abilities. In fact, the variables you choose can even be considered mediocre by most traders' standards because what you are going to learn from doing this exercise is not dependent upon whether you actually make money. Okay, all right, let's move ahead so that we can get a better understanding what the author is trying to convey here. If you consider this exercise an educational expense, it'll cut down on the amount of time and effort you might otherwise expend trying to find the most profitable edges. For those of you who might be wondering, I'm not going to make any specific recommendation about what systems or variables you should use because I assume that most of the people reading this book are already well schooled in technical analysis. If you need additional assistance, there are hundreds of books available on the topic as well as system vendors who are more than willing to sell you their ideas. However, if you have made a genuine attempt to do this on your own but are still having problems picking a system, you can contact me at markdouglas.com or tradinginthezone.com and I'll make some recommendation. Whatever system you choose to use has to fit within the following specification. Trade entry. The variables you use to define your edge have to be absolutely precise. The system has to be designed so that it does not require you to make any subjective decisions or judgment about whether your edge is present. If the market is aligned in a way that conforms with the rigid variables of your system, then you have a trade. If not, then you don't have a trade. Period. No other extraneous or random factors can enter into the equation. All right, understood. Stop loss exit. The same condition apply to getting out of a trade that's not working. Your methodology has to tell you exactly how much you need to risk to find out if the trade is going to work or not, right? There is always an optimum point at which the possibility of a trade not working is so diminished, especially in relationship to the profit potential, that you're better off taking your loss and genuinely and getting your mind clear to act on the next edge. Okay, so that's where you'll put your SL or stop loss. All right. Now, next one. Okay, I'll have to go to the next page. It seems all right. Just give me one sec. Okay, all right. Let the market structure determine where the optimum point is rather than using an arbitrary dollar amount that you are willing to risk on a trade. Okay, so your SL should not be based on the money, it should be based on the market where the strategy or the edge in which you're working on is not, you know, working anymore, or it is the probability of its working is diminished to the point that you don't even want to check. Okay, now in any case, whatever system you choose, it has to be absolutely exact, requiring no subjective decision making. Okay, all right, just give me one sec. In between, please take a note, guys. Okay, you can do it the way I am doing, like making a PPT, or you can do it in your own way, writing it down in your own words, which is better. Okay. Again, no extraneous or random variables can enter into the equation. Now, time frame. Your trading methodology can be in any time frame that suits you, but all your entry and exit signals have to be at the same time frame. For example, if you use variables that identify a particular support and resistance pattern on a 30-minute bar chart, then your risk and profit objective calculation also have to be determined in a 30-minute time frame. Okay, that's also important. Uh, like it is looking very easy, but you need to make rules around it. Okay, all right. However, trading in one time frame does not preclude you from using another time frames as filters. For example, you could have as a filter a rule that states you are only going to take trades that are in the direction of the major trend. There's there is an old trading axiom that trend is your friend. It means that you have a higher possibility of success when you trade in the direction of the major trend. If there is one, in fact, the lowest risk trade with the highest possibility of success occurs when you are buying dips, support in an uptrending market, or selling rallies, resistance in a downtrending market. To illustrate how this rule works, let's say that you have chosen a precise way of identifying support and resistance patterns in a 30-minute time frame as your edge. The rule is that you are only going to take trades in the direction of the major trend. A trading market is defined as a series of higher highs and higher lows for an uptrending market, and a series of lower highs and lower lows for a downtrending market. Right? Now, the longer the time frame, the more significant the trend. Also, a trending market on a daily bar chart is more significant than a trending market on a 30-minute bar chart. Okay, important. So basically, you can do the analysis part in the higher time frame, is what author is trying to convey over here. Therefore, the trend on the daily bar chart would take precedence over the trend on the 30-minute bar chart and would be considered the major trend. To determine the direction of the major trend, look at what is happening on a daily bar chart. If the trend is up on the daily, you are only going to look for a sell off or retracement down to what your edge define as support on the 30-minute chart. Okay, understood. Very important. First of all, you're finding out the trend, then you're finding out the entry. Okay, if you're getting the possibilities in your direction, then only you are trading, otherwise, you are not taking any trade. That's where you will become a buyer. On the other hand, if the trend is down on the daily, you are only going to look for a rally up to what your edge defines as a resistance level to be a seller on the 30-minute chart. Your objective is to determine in a downtrending market how far it can rally on an intraday basis and still not violate the symmetry of the longer trend. In an uptrending market, your objective is to determine how far it can sell off on an intraday basis without violating the symmetry of the longer trend. There is usually very little risk associated with these intraday support and resistance points because you don't have to let the market go very far beyond them to tell you the trade isn't working. Taking profits. Now, this is very important. Believe it or not, of all the skills one need to learn to be a consistently successful trader, learning to take profit is probably the most difficult to master. A multitude of personal, often very complicated psychological factors, as well as the effectiveness of one's market analysis, enter the equation. Unfortunately, sorting out this complex matrix of issues goes way beyond the scope of this book. I point this out so that those of you who might be inclined to beat yourself up for leaving money on the table can relax and give yourself a break. Even after you have acquired all the other skills, it might take a very long time before you get this one down pat. Don't despair. There is a way to set up a profit taking regime that at least fulfills the objective of the fifth principle of consistency. I pay myself as the market makes money available to me. If you're going to establish a belief in yourself that you are a consistent winner, then you will have to create experience that correspond with the belief because the object of the belief is winning consistently. How you take profits in a winning trade is of paramount importance. This is the only part of the exercise in which you will have some degree of discretion about what you do. The underlying premise is that in a winning trade, you never know how far the market is going to be in your direction. Markets rarely go straight up or straight down. Many of the Nasdaq internet stocks in the fall of 1999 were an obvious exception of this statement. Typically, markets go up and then retrace some portion of the upward move, or go down and then retrace some portion of the downward move. These proportional retrace can make it very difficult to stay in a winning trade. You would have to be an extremely sophisticated and objective analyst to make the distinction between a normal retracement when the market still have the potential to move in the original direction of your trade, and a retracement that isn't normal when the potential for any further movement in the original direction of your trade is greatly diminished, if not non-existence. If you never know how far the market is going to go in your direction, then when and how do you make profits? The question of when is a function of your ability to read the market and pick the most likely spots for it to stop. In the absence of an ability to do this objectively, the best course of action for psychological perspective is to divide your position into thirds or quarters and scale up the position as the market moves in your favor. If you're trading future contracts, this means your minimum position for a trade is at least 3 or 4 contracts. For stocks, the minimum position is any number of shares that is divisible by 3. So you don't end up with an odd lot order. Here's the why I scale out of a winning position. When I first started trading, especially during the first 3 years, 1979 through 1981, I thoroughly and regularly analyzed the result of my trading activities. One of the things I discovered was that I really got stopped out of a trade for a loss without the market first going at least a little way in my direction. On average, only one out of every 10 trades was an immediate loser that never went in my direction. Out of the other 25 to 30% of the trades that were ultimately losers, the market usually went in my direction by 3 or 4 ticks before revising and stopping me out. I calculated that if I got into the habit of taking at least a third of my original position of every time the market gave me those 3 or 4 ticks, at the end of the year, the accumulated winning would go a long way towards paying my expenses. Okay, understood. So, in simple words, for an example, let's say you're trading with 2 lots, okay, and you are very sure that whatever trade you have taken in the past, it went up to 10 points, and then even ultimately after 10 points, on an average, it went up to 10 points, and then it came back in the opposite direction and ultimately became loser. So, the trader or the what I can say, the author is trying to say whenever you are very certain, okay, it every trade or almost every trade that you're putting in or you're punching in, it is going 10 points up from your entry. So make sure that you're booking one lot at 10, okay, and then with the remaining lot you're going to check if it is still going to go up or it is coming back down. All right, so ultimately in a longer period of time you're going to be profitable if you'll trade in this manner. So this is a way to book your profits. I was right. To this day, I always, without reservation or hesitation, take off a portion of a winning position whenever the market gives me a little to take. This is very important thing to learn. Okay. All right. Just give me one sec. Great. Let me add another slide so that we can move forward. All right. These are just the ways to become profitable in a longer period of time. All right. Now, how much that might be depends on the market. It will be a different amount in each case. For example, in Treasury bond futures, I take a third of my position off when I get 4 ticks. In the S&P futures, I take a third off for a profit of 1.5 to 2 full points. In a bond trade, I usually don't risk more than 6 ticks to find out if the trade is going to work. Using a 3 contract trade as an example, here's how it works. If I get into a position and the market immediately goes against me without giving me at least 4 ticks first, I get stopped out of the trade for an 18 ticks loss. But as I have indicated, this doesn't happen often. More likely, the trade goes in my favor by some small amount before coming becoming a loser. If it goes in my favor by at least 4 ticks, I take those 4 ticks on one contract. What I have done is reduce my total risk on the other 2 contracts by 10 ticks. If the market then stops me out on the last 2 contracts, the net loss of the on the trade is only 8 ticks. If I don't get stopped out on the last 2 contracts and the market moves in my direction, I take the next third of the position off at some predefined determined profit objective. This is based on some longer time frame support or resistance, or on the test of a previous significant high or low. When I take profits on the second, third, I also move the stop loss to my original entry point. Hmm. Okay. So in this way, you're doing trading in a systematic manner. Not just you're booking the profit, but also you're making sure that you are, decreasing the chances of getting stopped out, or losing big for that matter. Now I have a net profit on the trade regardless of what happens to the last third of the position. In other words, I now have a risk-free opportunity. I can't emphasize enough, nor can be the publisher make the words on this page big enough to stress how important it is for you to experience the state of risk-free opportunity. Okay, what is risk-free opportunity is also we have to take a note of, right? Risk-free opportunity, the way he's trying to book the trades. Great. Hmm. All right. Now, moving ahead, I can't emphasize enough, nor can be the publisher make the words on this page big enough to stress how important it is for you to experience the state of risk-free opportunity. When you set up a situation in which there is a risk-free opportunity, there's no way to lose unless something extremely unusual happens, like a limit up or limit down move through your stop. If under normal circumstances there is no way to lose, you got the experience what it really feels like to be a trade with a relaxed, carefree state of mind. Very important. Now I'm understanding the logic behind it, and that's why it is getting more important to me. That why we need to do what we need to do. And as you become clear with what you are doing, then it becomes a part of your belief system and it becomes easy. To illustrate this point, imagine that you are in a winning trade. The market made a fairly significant move in your direction, but you didn't take any profits because you thought it was going even further. However, instead of going further, the market trades all the way back to or very close to your original entry point. You panic and as a result liquidate the trade because you don't want to let that was let what was once a winning trade turn into a loser. But as soon as you are out, the market bounces right back into what would have been a winning trade. If you had locked in some profits by scaling out, putting yourself in a risk-free opportunity situation, it's very unlikely that you would have panicked or felt any stress or anxiety for that matter. I still have a third of my position left. What's now? I look for the most likely place for the market to stop. This is usually a significant high or low in a longer time frame. But I place my order to liquidate just below that spot in a long position or just above that spot in a short position. I place my orders just above or just below because I don't care about squeezing the last tick out of the trade. I have found over the years that trying to do that just isn't worth it. One other factor you need to take into consideration is your risk to reward ratio. The risk to reward ratio in is the dollar value of how much risk you have to take related to the profit potential. Ideally, your risk to reward ratio should be at least 3 is to 1. Okay, it will be 1 is to 3. Risk is 1 and reward is 3. Basically, that's what author is trying to say over here. Okay, don't take it otherwise. All right, great. Now, moving ahead, which means you are only risking $1 for every $3 of your profit potential. If your edge and the way you scale out of your trades give you a 3 to 1 risk to reward ratio, your winning trade percentage can be less than 50% and you still make money consistently. A 3 to 1 risk to reward ratio is ideal. However, for the purpose of this exercise, it doesn't matter what it is, nor does it matter how effectively you scale out. As long as you do the best you can to pay yourself at reasonable profit levels when the market makes the money available. Every portion of a trade that you take of a winner will contribute to your belief that you are a consistent winner. Okay. All the numbers will eventually come into better alignment as your belief in your ability to become Be consistent, become stronger, right? That is also important. So booking small profits or like taking some portion out of your total position size is going to help you not just financially, but it will help you psychologically as well, right? Hmm. Trading in sample sizes. The typical trader practically lives or dies emotionally on the results of the most recent trade. If it was a winner, he'll gladly go to the next trade. If it wasn't, he'll start questioning the viability of his edge. To find out what variables work, how well they work, and what doesn't work, we need a systematic approach, one that doesn't take any random variables into consideration. This means that we have to expand our definition of success or failure from the limited trade by trade perspective of the typical trader to a sample size of 20 trades or more. That makes sense, isn't it? So after one winning trade, you are not thinking, okay, it is a great trade and I'm a winner. And so similarly, after losing one trade, you are not thinking, okay, I'm a winner or, I'm a loser and there is this continuous losing streak and all. Any edge you decide on will be based on some limited number of market variables or limit relationship between these variables that measure the market's potential to move either up or down. From the market's perspective, each trader who has the potential to put on or take off a trade can act as a force on price movement and is therefore a market variable. No edge or technical system can take into consideration every trader and his reason for putting on or taking off a trade. As a result, any set of market variables that defines an edge is like a snapshot of something very fluid, capturing only a limited portion of all the possibilities. Okay, let's go through it once again. Okay, any edge you decide on will be based on some limited number of market variables or relationship between those variables that measure the market's potential to move either up or down. From the market's perspective, each trader who has the potential to put on or take off a trade can act as a force on price movement and is therefore a market variable. No edge or technical system can take into consideration every trader and his reasons for putting on a or taking off a trade. As a result, any set of market variables that defines an edge is like a snapshot of something very fluid, capturing only a limited portion of all the possibilities. When you apply any set of variables to the market, they may work very well over an extended period of time. But after a while, you may find that their effectiveness diminish diminishes. Hmm. That's because the underlying dynamics of the interaction between all the participants, the market is changing. New traders come into the market with their own unique ideas of what is high and what is low, and other traders leave. Makes sense. All right. Let me take it. Note out. Little by little, these changes if affect the underlying dynamics of how the market moves. No snapshot, rigid set of variables can take these subtle changes into consideration. You can compensate for these subtle changes in the underlying dynamics of market movement and still maintain a consistent approach by trading in a sample sizes. Your sample size has to be large enough to give you your variables a fair and adequate test, but at the same time small enough so that if their effectiveness diminishes, you can detect it before you lose an inordinate amount of money. I found that a sample size of at least 20 trades fulfill both of these requirements. Simple size your sample size has to be large enough to give your variables a fair and adequate test, but at the same time small enough so that it's if their effectiveness diminishes, you can detect it before you lose an inordinate amount of money. Makes sense, makes sense. All right. Hmm. Testing. Once you decide on a set of variables that confirm to these specification, you need to test them to see how well they work. If you have the appropriate software to do this, you're probably already familiar with the procedure. If you don't have testing software, you can either forward test your variables on or hire a testing service to do it for you. Back testing is what they are trying to say over here. Okay. Alrighty. If you need a recommendation for a testing service, contact me at markdouglas.com or tradinginthe.zone.com for a referral. In any case, keep in the mind that the object of the exercise is to use trading as a vehicle to learn how to think objectively in the market's perspective, as if you were a casino operator. Right now, the bottom line performance of your system isn't very important, but it is important that you have a good idea of what you can expect in the way of a win to loss ratio, the number of winning trades relative to the number of losing trades for a sample size. Accepting the risk. A requirement of this exercise is that you know in advance exactly what your risk in is on each trade in your 20 trade sample size. As you know how as you now know, knowing the risk and accepting the risk are two different things. I want you to be comfortable as possible with the dollar value of the risk you are taking in this exercise, because the exercise requires that you use a 20 trade sample size. The potential risk is that you will lose on all 20 trades. This is obviously the worst case scenario. It is as likely an occurrence as that you will win on all 20 trades, which means it isn't very likely. Nevertheless, it is a possibility. Therefore, you should set up the exercise in such a way that you can accept the risk in dollar value of losing all 20 trades. For example, if you are trading S&P futures, your edge might require that you risk 3 full points per contract to find out if the trade is going to work. Since the exercise required that you trade a minimum of 3 contracts per trade, the total dollar value of the risk per trade is $2,250. If you use big contracts, the accumulated dollar value of risk if you lose on all 20 trades, it will be $45,000. You may not be comfortable risking $45,000 on this exercise. If you're not comfortable, you can reduce the dollar value of the risk by trading S&P mini contracts. E-mini, they are one fifth the value of the big contract. So the total value of the risk per trade goes down to 450, and the accumulated risk for all 20 trades is now 9,000. You can do the same thing if you are trading stocks. Just keep on reducing the number of shares per trade until you got a point where you are comfortable with the total accumulated risk for all trades, all 20 trades. Okay, all right. What I don't want you to do is change your established risk parameters to satisfy your comfort levels. If based on your research you have determined that a 3 point risk in the S&P is the optimum distance, you must let the market trade against your edge to let you if to tell you it isn't worth staying in the position, then leave it at 3 points. Change this variable only if it is warranted from a technical analysis perspective. If you have done everything possible to reduce your position size and find that you still aren't comfortable with the accumulated dollar value of losing on all 20 trades, then I suggest you to do the exercise with a stimulated brokerage service. Okay, all right. That means paper trading. In simple words, you can take it like paper trading. All right, stimulated brokerage service. With a stimulated brokerage service, everything about the process of putting on and taking off trades, including bills and brokerage statements, is exactly the same as with an actual brokerage firm, except that the trades are not exactly actually entered into the market. As a result, you don't actually have any money at risk. A simulated brokerage service is an excellent tool to practice with in real time under real market condition. It is also an excellent tool for forward testing a trading system. There may be others, but the only service of this nature that I know of it is audittrack.com. Okay, I'll take a note of it. We'll see how helpful this is. Right. Hmm. Doing the exercise, when you have a set of variables that conforms to the specifications described, you know exactly what each trade is going to cost to find out if it's going to work. You have a plan for taking profits and you know what you can expect as a win loss ratio for your sample size, then you are Ready to begin the exercise. The rules are simple. Trade your system exactly as you have designed it. This means you have to commit yourself to trading at least the 20 occurrence of your edge, not just the next trade or the next couple of trades, but all 20, no matter what. You cannot deviate, use, or be influenced by any other extraneous factor like momentum in my case, or change the variables that define your edge until you have a completed a full sample size. By setting up the exercise with rigid variables that define your edge, relatively fixed odds, and a commitment to take every trade in your sample size, you have created a trading regime that duplicates how a casino operates. And that's what we are trying to accomplish in the very beginning of this exercise, right? Because in the longer run, you will be profitable. Simple maths. Okay. All right. Great. Let's move ahead. Why do casinos make consistent money on an event that has a random outcome? Because they know that over a series of events, the odds are in their favor. And that's what we are also trying to work on. In longer run, the trades will be in our favor. They also know how that to realize the benefits of the favorable odds, they have to participate in every event. They can't engage in a process of picking and choosing which hand of blackjack, spin of the roulette wheel, or roll of the dice they are going to participate in. By trying to predict in advance the outcome of each of these individual events, if you believe in the five fundamental truths and you believe that trading is just a probability game, not much different from pulling the handle of a slot machine, then you will find that this exercise will be effortless because your desire to follow through with your commitment to take every trade is in your sample size, and your belief is the probabilistic nature of trading will be in complete harmony. As a result, there will be no fear, resistance, or distracting thoughts. What could stop you from doing exactly what you need to do when you need to do when you need to do it without reservation or hesitation? Nothing. On the other hand, if it hasn't already occurred to you, this exercise is going to create a head on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with the desire. Okay. The amount of difficulty you have in doing this exercise will be in direct proportion to the degree to which these conflicts exist. To one degree or another, you will experience the exact opposite of what I described in the previous paragraph. Don't be surprised if you find your first couple of attempts at doing this exercise virtually impossible. How should you handle these conflicts? Monitor yourself and use the technique of self-discipline to refocus on your objective. Write down the five fundamental truths and the seven principles of consistency and keep them in front of you at all times when you're trading to give you a to give you a reality check basically, right? Okay, I'm adding another slide. Just give me one sec. Mm-hmm. No way. Okay. All right, now it is fine. Okay, let's move back. Repeat them to yourself frequently with conviction every time you notice that you are thinking, that saying or doing something that is consistent with these truths or principles. Acknowledge the conflict. Don't try to deny the existence of complete conflicting forces. They are simply parts of your psyche that are arguing for their version of the truth. Makes sense, isn't it? Hmm. When this happens, refocus on exactly what you are trying to accomplish. If your purpose is to think objectively, disrupt the association process so you can stay in the now moment opportunity flow, step through your fears of being wrong, losing money, missing out, and leaving money on the table so you can stop making errors and start trusting yourself. Then you'll know exactly what you need to do. Follow the rules of your trading regime as best as you can. Again, if you lose, like if you're failing in the first few attempts, that doesn't mean that you have to feel disheartened and you have to feel very bad or you have to feel like a loser. No, shouldn't. You should try again. Follow the rules of your trading regime as best as you can. Doing exactly what your rules call for while focused on the five fundamental truths will eventually resolve all your conflicts about the true nature of trading. Very important. hmm Just give me one sec. Why it is still green? I changed the color to black, right? Hmm. Okay, let's move ahead. We are at the very end of this chapter. Every time you actually do something that confirms one of the five fundamental truths, you will be drawing energy out of the conflicting beliefs and adding energy to a belief in probabilities and in your ability to produce what I can say consistent result. Every line feels like something that is needed to take a note of or something around it. And that's very important. That's the crux of whatever we are trying to cover so far. That's why I have to take a note more and more. Eventually, your new beliefs will become so powerful that it'll take no conscious efforts on your part to think and act in a way that is consistent with your objective. You'll know for sure that thinking in probability is a probability is a functioning part of your identity when you will be able to go through one sample size of at least 20 or more traits without any difficulty, resistance, or conflicting thoughts distracting you from doing exactly what your mechanical system calls for. Then and only then will you be ready to move into the more advanced subjective or intuitive stage of trading. Okay, so basically you have to follow a system till the time you're so comfortable with the system, and then you can move to the next stage. That means trading intuitively, because it is now become the part of your belief system. Till the time it is not becoming the part of your belief system, you have to consciously work for it. Okay, all right, now moving ahead. A final note: try not to prejudge how long it will take before you can get through at least one sample size of trades. Following your plan without deviation, distracting thoughts, or hesitations to act, it'll take as long as it takes. If you wanted to be a professional golfer, it wouldn't be unusual to dedicate yourself to hitting 10,000 or more golf balls until the precise combination of movements in your swing were so ingrained in your muscle memory that you no longer had to think about it consciously. When you are out there hitting those golf balls, you aren't playing an actual game against someone or winning the big tournament. You do it because you believe that skill acquisition and practice will help you win. Learning to be a consistent winner as a trader isn't any different. I wish you great prosperity and would say good luck, but you really won't need luck if you work at acquiring the appropriate skills. Very, very important. Thank you so much, Sir Mark Douglas. It was a very lovely insight. And even though you can't hear me, but I'm really grateful because you wrote this book. Okay. Now, attitude survey. To make money as a trader, you have to know what the market is going to do next. Agree or disagree? No, I disagree. Based on the book, sometimes I find myself thinking that there must be a way to trade without having to take a loss. No, I disagree. Making money as a trader is primarily a function of analysis. Disagree. Losses are an unavoidable component of trading. Agree. My risk is always defined before I enter a trade. Agree. In my mind, there is always a cost associated with finding out what the market may do next. Agree, predefined loss. I wouldn't even bother putting on the next trade if I wasn't sure that if it was going to be a winner. No, I have to take chance. Disagree. The more a trader learns about the markets and how they behave, the easier it will be for him to execute his trades. No, not about the market, about his own belief system and in a longer time frame how it has to work on. So I disagree. My methodology tells me exactly under what market condition to either enter or exit a trade. Agree. It needs to be like that. Even when I have a clear signal to reverse my position, I find it extremely difficult to do so. If I'll talk about my recent or lately experiences, then yeah, I'll have to agree, but I'll have to change it to disagree very soon. Okay. When I first started trading, I would describe my trading methodology as haphazard, meaning some success in between a lot of pain. Agree. I'll have to change it to disagree though. I often find myself feeling that the market are against me personally. Disagree. Initially, I used to think it in that manner, but now no. As much as I try to let go, I find it very difficult to put past emotional wounds behind me. Okay, slightly agree. I have a money management philosophy that is founded in the principle of always taking some money out of the market when the market makes it available. Agree. I'll have to stick to it. This is very, very, very important. Okay. That's it. This is one of the key learning from this book for me personally because I have seen my winning trades turning into losing trades. A trader's job is to identify patterns in the market behavior that represents an opportunity and then to determine the risk of finding out in these patterns will pay themselves out as they have in the past. Okay, I'll go through it again. A trader's job is to identify patterns in the market's behavior that represent an opportunity and then to determine the risk of finding out if these patterns will play themselves out as they have. Yes, agree. So basically, you just have an edge and you're putting some amount to just check if the pattern or the edge is going to work this time or not. Sometimes I just can't help feeling that I'm a victim of the market. Lately, I have felt it, but yeah, I disagree because all market, all the thing like market, what exactly it is doing, it is just providing me with the neutral information. I am the one who is putting the emotional uh, feelings behind it, emotional meanings to it, and then playing victim and whatever. Okay. When I trade, I usually try to stay focused in one time frame. Agree. Yeah, I stick to 5 minute time frame, but yeah, I do check 15 and 1 hour and bigger time frame as well. Trading successfully requires a degree of mental flexibility far beyond the scope of most people. Agree. There are times when I can definitely feel the flow of the market. However, I often have difficulty acting on these feelings. Slightly agree, not strongly agree. There are many times when I am in a profitable trade and I know the move is basically over, but I still won't take my profits. No, disagree. I do take my profits. If there is this feeling, okay, the trend is over and stuff, I exit as soon as I feel like it is not breaking the higher highs. And I have seen many a times the trend is going to reverse from the very position when I exit. I've seen the other way around as well. Like it went up from that point, but yeah, I chose the safer exit and I'm happy about it. No matter how much money I make in a trade, I'm really ever satisfied and feel that I could have made more. No, that's not the case. I disagree. When I put on a trade, I feel sometimes I do basically. When I put on a trade, I feel I have a positive attitude. I anticipate all of the money I could make from the trade in a positive way. I do, but it didn't turn out exactly fine because my action steps were not in the it was not aligned with what I was trying to achieve. The most important component in a trader's ability to accumulate money over time is having a belief in his own consistency. Yes, strongly agree. Like this is something that I have to learn. Like I have to make a part of my belief system. If you're granted a wish to be able to instantaneously acquire one trading skill, what skill would you choose? Hmm. Interesting question. If you were granted a wish to be able to instantaneously acquire one trading skill, sticking to my rules. That's the trading skills that I require. I have everything. I have an edge. I have a set of rules. Like I can work on them. Like I can tweak them a little bit here and there. But yeah, I do have these two. But sticking to rules is very important, right? I often spend sleepless night worrying about the market. No, never. Disagree. Do you ever feel compelled to make a trade because you are afraid that you might? Strong, yes. Home, I have been through it again and again. It was like one of the major reason I entered in a lot of trades. Although it doesn't happen very often, I really like my trades to be perfect. When I make a perfect call, it feels so good that it makes up for all the times that I don't. No, not really, but I have had this feeling when I felt like, okay, this was the perfect trade. But does that mean it clears all the mistakes that I have committed in past? No. Do you ever find yourself planning trades you never execute and executing trades you never planned? Yes. The second part, yes. In a few sentences, explain why most traders either don't make money or aren't able to keep what they make. Hmm. Because of the uncertainty and their belief system around that uncertainty, right? They don't have the right attitude to see and perceive the market objectively, and they, you know, get in flow with the feelings rather than being objective, and that's why they either lose money or what I can say, they don't make money, whatever the situation was. They aren't able to make the money. Okay, so by this we are coming to the end. So I gave the answer according to myself. You can do this exercise all by yourself, and I hope this book was really helpful to you, because it was very helpful for me at least. In case if you have doubt in any of the concept that we discussed, or you want me to, you know, take a separate class on any interesting topic that came out from here, and even a technical topic that you want me to discuss, you can post it in the comment and we'll, do it together. And I'm wishing you all the very best for your trading journey ahead. I hope you are following this and it worked very fine, for like it had some impact in your belief system in a positive manner, obviously. Okay, so on this positive note, let's just end the sessions. Sessions basically means the sessions of this particular book. And for now, let's just end this session particularly. So thank you so much if you have come so far. In case you want, if you want to say anything in the anything, any piece of advice, any suggestion, the comment box is open for that. And we'll meet next time with some other book in psychology, most probably, like trading psychology. And yes, thank you so much. Thank you so much, universe. Thank you so much, Radha Ranji. Peace out.